Usually when we talk about ownership, there is a very comforting, clear physical reality to it.
Right, like holding a physical deed to a house or something.
Exactly. You hold a piece of real estate, you have that deed, a fence, tangible borders, or like you hold a gold coin in your hand. You actually feel the density of it and you just know it's yours.
Because the physics of the universe dictate that you possess that object.
Yeah, and if someone wants to change what that gold coin is, they have to physically melt it down with immense heat. I mean, the rules governing that object are basically set by nature.
The physical world provides this undeniable sense of finality. Tangible ownership is binary, and the properties of the asset are immutable.
Right.
You don't have to worry that the gold in your safe is going to suddenly rewrite its own atomic structure overnight just because a group of people held a vote.
But then you step into the world of decentralized digital networks, and suddenly that comforting physical reality just completely vanishes.
It evaporates entirely.
It really does. We are looking at a landscape where ownership is entirely conceptual. It relies on a shared hallucination of rules, like a vast network of computers constantly verifying a ledger based on software code.
Which brings up a really fascinating dynamic.
Yeah, it brings up a seemingly simple question for you, the listener. Who actually owns Bitcoin? Welcome to today's deep dive.
It's great to be here to get into this one.
Our mission today is to unpack one of the most intense, high-stakes, philosophical, and technical battles in the entire history of decentralized networks.
The stakes were incredibly high.
We are going to explore the story of Bitcoin BIP-110, which was formally assigned in December 2025.
It really is the ultimate trick question, asking who owns it, because the answer is both everyone participating in the network and absolutely no one entity.
Right, there's no CEO to call.
Exactly. There is no corporate headquarters. But to look at BIP-110 as just a routine technical software update would be missing the entire narrative.
Oh, completely.
What we are examining today is a literal battle for the soul and the core identity of the most famous cryptographic network on Earth.
Okay, let's unpack this. We have a massive stack of sources for this deep dive. We've got developer mailing lists, node operator manifestos, exchange autopsy reports, you name it.
A lot of very heated late-night forum posts.
Yeah, exactly. And we are going to look at how a seemingly obscure piece of code almost tore a trillion-dollar ecosystem right down the middle.
Because this wasn't just a squabble among a few coders.
No, this affected everything from the retail wallet sitting on your phone to the sovereign treasury reserves of major nation-states.
The visual backdrop we have set up for this deep dive, this sprawling, glowing network map of global data streams that you can picture, it's the perfect representation of the stakes involved here.
Everything is connected.
Right. When you pull one single thread in a permissionless network like this, the vibrations ripple outwards instantly.
And everyone feels it.
The tension is felt by industrial mining farms in remote locations, by executives at massive Wall Street institutions managing ETFs, and by, individual cypherpunks running nodes on Raspberry Pis in their living rooms.
Everyone's interests just suddenly collided.
Every single participant found their financial and philosophical interests colliding all at once.
So we know this collision caused a massive fight. But before people were drawing battle lines and threatening to fork the network, there was a massive boom in what you might call digital real estate on the Bitcoin blockchain.
It was a literal gold rush for block space.
Right. So let's look at the actual proposal itself, BIP-110, and the specific technical environment that turned this whole ecosystem into a powder keg waiting for a match.
Which was formally proposed by Dathan Ohm.
Yeah, in December 2025. And it had this incredibly dry title, the Reduced Data Temporary Soft Fork.
The bureaucratic naming convention definitely masks the severity of the proposal, that's for sure.
It sounds like a minor software patch.
It really does.
Yeah.
But to understand the friction, we have to look at the mechanics of what a soft fork actually is and why the word temporary was so controversial.
Right.
A soft fork, at its core, is a backward-compatible tightening of the network's rules. It basically means the new rules restrict something that was previously allowed.
Okay, so backward compatible tightening.
Yeah, so non-upgraded nodes will still recognize the blocks produced by upgraded nodes as valid.
Because the upgraded blocks are just following a stricter subset of the existing rules, right?
Exactly. They aren't breaking any old rules, they're just adding new, tighter ones for themselves.
So it's like a club where the dress code used to be wear whatever you want, and the soft fork changes it to collared shirts only.
That's a great way to look at it.
The people who still think the rule is wear whatever, they'll look at a guy in a collared shirt and say, yeah, he's allowed in. But the
Right.
strict bouncers will reject anyone who shows up in a t-shirt.
That captures the backward compatibility perfectly. But the catalyst for this specific dress code change was a profound shift in how the network was actually being utilized.
Right, the new protocols.
The controversy centered around the massive, unprecedented demand for block space caused by protocols like Ordinals, BRC-20 tokens, and runes.
These weren't standard financial transactions, were they?
Not at all. These weren't sending BTC from Alice to Bob. These were mechanisms designed to embed arbitrary data, everything from images and text to complex token logic, directly onto the blockchain.
And to understand how they did this, we have to look at the loopholes, or rather, the unintended consequences of previous network upgrades.
Unintended is the key word there.
Yeah, I know our listeners are familiar with the basics of Bitcoin, but the specific mechanics of the SegWit and Taproot upgrades are really crucial here.
They are the foundation of this whole mess.
It reminds me of a postal service anomaly. Imagine the Bitcoin network is a post office. For years, people were mailing standard letters, which are basically financial transactions.
Just a standard envelope.
Right. Then an upgrade like segregated witness or SegWit comes along. It separates the signature data, the witness, from the main transaction data to make processing more efficient.
The network essentially offered a discount for data stored in that witness section to encourage users to adopt the new, more efficient format.
Right, so the post office basically says, hey, if you attach a secondary envelope to the outside of your letter for the signature, we will charge you a fraction of the postage rate for the weight of that outer envelope.
A heavily subsidized shipping rate.
Exactly. Then, a few years later, the Taproot upgrade removes the size limit on that outer envelope to allow for complex smart contracts. But human ingenuity takes over.
As it always does.
People realize, wait, there's no size limit and the postage is discounted. I'm not going to put a signature in there. I'm going to tape an entire heavy encyclopedia to the outside of my letter.
And that encyclopedia is the arbitrary data.
Yeah, they started packing massive files into the witness data because it was cheap.
The technical ingenuity of the Ordinals protocol was realizing that all of this data could be inscribed onto individual Satoshis and stored permanently in the witness data field, taking advantage of that exact discount you just described.
It's kind of brilliant in a way.
It is. Suddenly, the block space wasn't just clearing financial settlements. It was acting as a decentralized, immutable hard drive for digital collectibles and arbitrary code.
Which brings us back to Dathan Ohm and BIP-110. This proposal was designed to stop those heavy encyclopedias from being mailed.
It was a direct response.
But it couldn't just say, no JPEGs allowed, because the Bitcoin protocol doesn't know what a JPEG is, right? It just sees hexadecimal data.
Yeah.
So how did the proposal actually attempt to enforce this block?
The implementation required surgical precision to avoid breaking the core monetary functions. BIP-110 introduced 7 new consensus restrictions.
7 specific rules?
Yes. Instead of trying to identify the content of the data, the code targeted the structure and the mechanisms that these inscription protocols relied upon.
Okay, so looking at how the data was packaged, not what the data was.
Precisely. For instance, it placed strict new limitations on the size of certain up-return outputs and restricted the execution footprint of specific Taproot scripts.
It essentially said if a transaction utilizes this specific combination of scripting techniques that we know are heavily associated with data inscriptions, the nodes running BIP-110 will just consider that transaction invalid.
Exactly. It targeted the fingerprint of the protocols.
I have to admit, I'm slightly confused by the strategy of making this a temporary soft fork. The sources explicitly state this was designed to last for roughly 1 year.
That was a huge point of contention.
Does a 1-year pause actually solve the underlying architectural issue, or does it just, pause the inevitable evolution of the network?
The intention behind the temporary designation was really twofold, serving both a technical and political purpose.
Okay, let's start with the technical.
Technically, the proponents viewed it as a tourniquet. The network's mempool, which is the waiting room for unconfirmed transactions, was frequently overflowing.
The backlog was massive.
Huge. Fees were incredibly volatile. The temporary restriction was meant to immediately bleed off that pressure, giving developers a 1-year window to build and scale Layer 2 solutions.
So Layer 2 solutions where this non-monetary data could exist without competing with base layer financial settlement.
Right. It was supposed to buy time.
Buy time to build a designated cargo lane, essentially.
Yes, exactly. But politically, the word temporary was highly contentious. Critics viewed it as a dangerous Trojan horse.
Why a Trojan horse?
Because the argument against it was that censorship is a binary state. The protocol is either neutral or it is not.
Ah, I see.
Once you prove that developers can successfully coordinate a soft fork to restrict specific types of user behavior, you have completely shattered the illusion of neutrality.
Even if the restriction expires in a year, the precedent is permanently etched into the network's history.
Exactly. The capability has been proven.
This friction over neutrality leads us directly into the philosophical core of this entire event, because this stopped being a debate about data formatting very quickly.
Very quickly, it got ideological almost overnight.
It escalated into an existential crisis about the identity of the network.
Right.
We're looking at a profound divide over what the word spam actually means in a permissionless system.
The ecosystem essentially fractured into two distinct philosophical camps. For clarity, we can categorize them as the sound money purists and the protocol neutrality advocates.
Okay, the purists and the neutrality advocates. Let's look at the purist viewpoint first.
Their foundational belief is that Bitcoin's sole purpose, its unique value proposition to humanity, is serving as decentralized, censorship-resistant money.
So to them, the base layer is a financial settlement engine, full stop.
Period. Nothing else matters to them.
And from that perspective, anything that degrades the efficiency of that engine is a literal threat to the network.
A massive threat. And if we look at the hardware realities of running a node, this isn't just an abstract economic argument, it's a structural one.
Right, because every full node on the network has to download, process, and store every single block to independently verify the ledger.
Yes. If the blocks are constantly full of arbitrary data, the blockchain experiences massive state bloat.
And state bloat just means the total size of the ledger gets too big.
The concept of state bloat is central to the purist anxiety. When the blockchain grows exponentially in size, the hardware requirements to run a node increase proportionately.
Which pushes out the little guy.
Exactly. The initial block download, which is the time it takes for a brand new node to sync with the network from the Genesis block, stretches from days to weeks.
Wow.
And the bandwidth required to constantly relay these data-heavy blocks becomes totally prohibitive for users with just average internet connections.
And if running a node becomes too expensive or technically demanding for a normal person in their living room, the network inevitably centralizes.
It has to.
You end up with a system where only massive corporate server farms and specialized data centers can afford to validate the ledger.
Which completely undermines the trustless nature of the system.
Right, because if you cannot afford to run your own node, you are forced to trust a third party to tell you what your balance is and whether the network's rules are being followed.
The purists classify these arbitrary data insertions as spam, not just because they dislike digital collectibles, but because they view them as a parasitic load that actively degrades the decentralization of the monetary network.
Here's where it gets really interesting. Both sides of this debate genuinely believed they were the ones saving the network from destruction.
It was a battle of two very righteous factions.
The purists want to protect the function of the network as decentralized money, but the neutrality advocates want to protect the nature of the network as an unrestricted, permissionless platform.
Yes.
Let's look at the counterargument from the neutrality side. If I'm paying the miners the required fee, why should anyone care what data I'm transmitting?
The neutrality argument is rooted in pure free market Austrian economics. From this perspective, a decentralized protocol must be completely blind to the intent of the user.
It shouldn't judge.
It cannot and should not attempt to measure the subjective, moral, or economic utility of a transaction.
So if a multinational corporation pays $10 in fees to settle a billion-dollar international trade, and a cypherpunk pays $50 in fees to permanently inscribe a pixelated frog image onto the blockchain,
The protocol must treat both transactions with equal validity.
the market has spoken. If the frog image pays a higher fee, it deserves the block space more than the financial settlement.
According to the rules of the free market, yes. The neutrality advocates argue that trying to codify the definition of spam at the protocol level is an incredibly dangerous exercise in central planning.
Central planning on a decentralized network.
Exactly the irony. If developers possess the authority to dictate that financial data is legitimate, but arbitrary data is spam, they have basically assumed a regulatory role.
They are no longer maintaining a neutral protocol. They are actively curating acceptable use cases based on personal ideology.
It's a very compelling argument.
It really forces you, as the listener, to confront your own inherent biases about digital infrastructure.
Tough question.
In a system with mathematically constrained capacity, you have to choose a priority. Do you want a network that aggressively filters out non-monetary data to guarantee that peer-to-peer financial payments remain cheap, efficient, and accessible globally?
Or do you want an entirely uncensorable, neutral data campus where anyone can publish literally anything, provided they have the capital to outbid everyone else for the space?
The limited capacity is the defining constraint that makes this conflict unavoidable, isn't it?
It is. Block space is an artificially scarce resource maintained by cryptographic difficulty. Because you cannot simply spin up more block space without altering the fundamental rules of the system, the ecosystem is forced into a zero-sum game over how that scarce resource is utilized.
This high-level philosophy is fascinating, but philosophy alone doesn't rewrite consensus code.
No, it takes people to do that.
To understand how this ideological divide translated into actual trench warfare, we have to look at the individuals and groups leading these factions. We are talking about massive egos, entrenched power dynamics, and competing visions for the future.
The human element of this is intense.
Let's analyze the factions. Who specifically is pushing for BIP-110, and who is fighting against it?
The coalition supporting BIP-110 was formidable. It was naturally led by Dathan Ohm, the proposal's author, but it drew immense support from legacy figures in the development community.
Like who?
Luke Dash Jr., for example. He has been a highly vocal advocate for small blocks and lightweight node requirements for over a decade. His involvement lends significant technical credibility to the purist movement.
The small block advocates essentially want to ensure that a decade from now, you can still sync a Bitcoin node over a weak internet connection on cheap hardware. But the muscle behind this faction wasn't just veteran developers, it was the independent node operators. And this brings up a concept we absolutely need to explore in depth, the UASF, or user-activated soft fork.
The user-activated soft fork is perhaps the most radical governance mechanism in the entire blockchain space.
Why is it so radical?
To understand why it's so disruptive, we have to look at the traditional assumption of how upgrades occur. Historically, the broader market assumes that miners dictate the rules because miners physically assemble the blocks and secure the network with hash power.
Right, they do the heavy lifting.
If miners signal support for an upgrade, it happens. If they don't, it fails.
But the UASF mentality completely flicks that hierarchy, doesn't it? It treats miners less like the rulers of the network and more like, well, hired contractors.
Exactly the case.
Yeah.
The UASF posits that the true sovereign power of the network lies with the economic nodes, the exchanges, the wallets, and the individual users validating their own transactions.
The people actually using the money.
Right. The mechanism works through coordinated defiance. A large contingent of users publicly agree to run a specific software client that enforces the new rules, in this case BIP-110, starting at a specific predetermined block height.
So they plant a flag in the ground and say, starting at block X, we are changing the dress code. If you miners produce a block that includes arbitrary data inscriptions, we simply will not recognize it.
The economic threat there is immense. If the nodes reject a miner's block, that block effectively ceases to exist from the perspective of those users.
The miner gets nothing.
The miner receives no block reward, no transaction fees, and wastes massive amounts of electricity. The UASF strategy attempts to force the miners into compliance by threatening to orphan their blocks and destroy their profit margins if they don't adopt the new rules.
It's the ultimate decentralized flex.
It really is.
But if we look across the battlefield at the faction opposing BIP-110, we see some heavy hitters who fundamentally disagree with this tactic. We are talking about Jameson Lopp, Adam Back, and a significant portion of the Bitcoin core development team.
The institutional veterans.
The sources show that the very architects of the system, the people actively maintaining the repository, were deeply opposed to this. Why would the developers who build the network be so terrified of a proposal aimed at keeping the blockchain clean?
The opposition from veteran developers like Adam Back wasn't necessarily a defense of ordinals or JPEGs. Their opposition was rooted in the extreme danger of the method itself.
The UASF method.
Yes. Their primary directive is maintaining systemic consensus. A cryptographic network's entire value relies on a single, shared, unbroken reality.
Everyone has to agree on the ledger.
Right. When a faction attempts to force a contentious soft fork, meaning an upgrade that lacks overwhelming, near-unanimous consensus across all participants, they introduce the massive risk of a chain split.
Because if 50% of the nodes enforce BIP-110 and the other 50% reject it, the network literally fractures into two parallel universes operating simultaneously.
The systemic risk is catastrophic. Furthermore, the core developers evaluate risk on a multi-decade time horizon. The technical execution of BIP-110 involved restricting specific scripting capabilities introduced during the Taproot upgrade.
And what's the danger there?
Application developers argue that you cannot foresee the unintended consequences of breaking those capabilities. By retroactively restricting Taproot to filter out arbitrary data today, developers feared they might accidentally break the foundational tools required to build complex privacy enhancements or advanced smart contracts tomorrow.
So we have this intense standoff. Independent node operators are willing to risk a civil war to protect the base layer right now, while veteran developers and neutrality advocates are warning that forced intervention will shatter the network's consensus model.
A total deadlock.
But while these factions debate game theory on developer forums, there are massive entities in the real world bracing for impact. Let's look at the economic domino effect. If a contentious fork actually happens, what happens to the miners, the retail exchanges, and the wallet providers?
The mining industry found itself in a uniquely terrifying position. From a strict revenue perspective, the explosion of arbitrary data was a massive financial windfall.
Because of the high fees.
Exactly. The protocols generating this data were highly inefficient and required massive transaction fees to secure block space. Miners were reaping record profits from these fees.
And BIP-110 threatened that.
If BIP-110 successfully activated, a massive, lucrative segment of their customer base would be instantly vaporized.
And we have to view this in the context of the network's issuance schedule. The block subsidy, the newly minted coins miners receive, is constantly decaying. Miners desperately need robust fee markets to maintain profitability as that subsidy approaches zero.
They need that fee revenue to survive.
But you mentioned earlier that the fear of losing revenue pales in comparison to the operational terror of a chain split. Let's dig into the mechanics of orphan risk. What is that?
Orphan risk is the mechanism that keeps miners brutally honest and highly conservative. Mining is a heavy industry. It requires deploying millions of dollars in ASIC hardware and consuming industrial quantities of electricity to perform the cryptographic hashing required to find a valid block.
It's extremely capital intensive.
Very. If a miner decides to signal support for the BIP-110 minority chain out of philosophical agreement, they are committing real-world energy to that specific ledger.
But if the broader economic majority of the network stays on the legacy chain and ignores the BIP-110 rules, that miner's newly found block is completely isolated.
It becomes an orphan block. The network just discards it.
Wow.
The miner receives zero block subsidy and zero transaction fees. They've literally burned electricity for nothing.
In an industry defined by razor-thin margins and massive debt obligations for hardware, sustaining a high orphan rate for even a few days will trigger bankruptcy.
Exactly. Therefore, miners cannot afford to be philosophical pioneers. Game theory dictates they must meticulously analyze market sentiment and point their hash power at whichever chain is most likely to retain the dominant economic value, regardless of their personal feelings about data bloat.
So the miners are essentially hostage to economic consensus. They follow the money.
They have to.
But how do the entities that actually interface with the public handle this? If I'm running a major centralized exchange like Coinbase or Binance, and the network is barreling toward a contentious split, how do I actually manage that technically?
For an exchange, a contentious hard fork or a chaotic soft fork split is an operational nightmare that requires halting the entire machine. The most immediate and dangerous threat is replay risk.
This is a concept that trips a lot of people up. If the chain splits into chain A and chain B, how does the transaction replay?
To understand replay risk, you have to look at the cryptography of a transaction. When a user wants to move funds, they use their private key to generate a mathematical signature, proving they own the UTXO, the unspent transaction output.
The digital coin, basically.
Right. They broadcast that signed message to the network. Now, if the chain splits, both chain A and chain B share the exact same history up until the moment of the fork.
Meaning my balances are duplicated.
Yes. This means a user possesses identical UTXOs on both chains, secured by the exact same private key.
So if I log into my wallet and try to send one Bitcoin on the legacy chain to a friend, I broadcast that signature to the mempool. But the nodes running the new BIP-110 software are also monitoring the mempool.
They are watching everything too.
They see my signature. And because the signature is mathematically valid on their chain as well, they process it too.
Precisely. Without specific code implemented to separate the networks, which is known as replay protection, a transaction broadcast on one chain is inherently valid on the other,
A user attempting to move funds on the legacy chain will unknowingly move their parallel funds on the BIP-110 chain simultaneously.
which is a disaster.
For an exchange managing millions of customer accounts and massive hot wallets, this is catastrophic. They could attempt to process a withdrawal on one network and accidentally drain their reserves on the parallel network.
So they have to hit the emergency brake. They pause all deposits and withdrawals across the entire platform.
So what does this all mean for their back-end operations?
They freeze all movement. Their engineering teams have to scramble to audit complex multi-signature custody scripts, especially since BIP-110 specifically altered how Taproot functions operate.
They have to do a massive audit.
They have to run manual separation procedures to split their UTXOs securely across both chains before they can safely resume operations. And then they face the political nightmare, the ticker war.
Ah, the ticker war. This is where the power dynamics get really opaque. If the
Right.
network actually fractures into two viable surviving chains, who gets to keep the BTC symbol on the trading terminal?
That is the million-dollar question.
Because whichever chain gets designated as BTC inherently absorbs the brand recognition and the vast majority of retail liquidity. I always think of it like a bank vault cloning itself.
That's a good analogy.
You have this bank where the vault has suddenly cloned itself, but only one clone is legally recognized and nobody knows which one yet.
Exchanges try to avoid playing kingmaker, but in a split, they're forced to make a subjective judgment call. They monitor hash rate allocation, node counts, and futures market pricing to determine which chain is the legitimate continuation of the protocol.
Wallet providers face the exact same chaos, don't they?
Absolutely. They have to push emergency software updates, implement tools for users to split their coins, and try to explain complex cryptographic replay risks to retail users who simply want to access their savings.
The systemic risk is immense, and it highlights why established businesses hate contentious forks. But if this is a nightmare for a retail exchange, the implications become truly staggering when we scale up to the entities that deal in billions and trillions of dollars.
The big players.
Let's look at the macroeconomic and geopolitical level. Over the last decade, we've seen Bitcoin deeply integrate into traditional finance. We have Wall Street ETFs, massive corporate treasurers, and sovereign wealth funds holding the asset. How does an institution managing an ETF handle a protocol civil war?
Institutions demand predictability above all else. They require pristine, highly liquid collateral. On a purely philosophical level, the narrative of BIP-110 is highly attractive to an institutional mindset.
Right, they want clean money.
A Wall Street asset manager doesn't want the underlying infrastructure of their multi-billion-dollar ETF bogged down by digital frog images. They want a streamlined, highly efficient monetary settlement layer. The digital gold narrative thrives on simplicity.
But the reality of achieving that simplicity through a contentious fork is what terrifies them.
The instability is poison to them.
If I'm the authorized participant managing a spot Bitcoin ETF and the network splits at 2:00 p.m. on a Tuesday, my pricing models instantly break.
The valuation mechanics descend into total chaos. An ETF must constantly calculate its net asset value, its NAV, based on the spot price of the underlying asset.
But which asset?
Exactly. If the chain splits, which asset are they tracking? If the legacy chain is trading at $60,000 and the new BIP-110 chain is trading at $10,000, what is the actual value of the fund?
Furthermore, the legal frameworks governing these funds rarely account for decentralized protocol splits.
And what about the lending markets? If a massive mining operation uses their Bitcoin treasury as collateral to secure a $100 million fiat loan, and the network splits, how does the lender value the collateral?
Does the borrower suddenly owe the lender funds from both chains to satisfy the margin requirements?
The legal ambiguity triggers massive risk-off behavior. Institutional risk models are forced to factor in protocol governance failure as a systemic threat.
But the complexity deepens even further when we look at sovereign nation-states, doesn't it?
It enters a whole new geopolitical realm.
Governments holding Bitcoin in their national treasuries face a unique set of geopolitical complications. A state cannot simply rely on an exchange to tell them which chain is legitimate.
Right. A sovereign nation has a fiduciary duty to its citizens and its national security. If the protocol splits, a nation-state has to deploy intelligence resources.
They have to figure it out themselves.
They have to monitor the global distribution of hash power, analyze the liquidity depth on decentralized markets, and make a formal state-level determination of which chain represents their sovereign wealth.
But the truly fascinating dynamic is the offensive capability a chain split provides. We have to consider the geopolitical wildcard. The traditional narrative is that Bitcoin is an unstoppable, monolithic protocol.
That's the selling point.
BIP-110, however, demonstrates that the rules of the network are mutable if enough economic actors coordinate to change them. Now, I want to push back on the standard assumption that governments would inherently fear this chaos. You'd think a sudden change to the rules would terrify a Treasury Department. But couldn't an intelligence agency look at the BIP-110 conflict and say, wait a minute, if a coordinated group of users and developers can successfully force the network to filter out arbitrary data, that proves the network can be coerced into filtering anything.
To take that a step further, the realization you just described is the exact scenario privacy advocates have warned about for years.
It's a slippery slope.
If the network demonstrates the technical and social capability to censor data based on subjective criteria like spam, it provides a literal roadmap for state actors. Furthermore, a split creates an arena for financial warfare by proxy.
How so?
Imagine Nation A and Nation B are locked in an economic conflict. They both hold significant Bitcoin reserves. Nation A publicly recognizes and points state-controlled hash power toward the BIP-110 chain, while Nation B supports the legacy chain.
So they could weaponize their hash rate. Or, even more directly, they could take the parallel assets they received on the opposing chain and market dump them to crash the liquidity and destroy the treasury value of their rival.
It turns decentralized governance into a theater for geopolitical proxy wars.
The vulnerability of subjective consensus opens up massive vectors for attack. And this exact vulnerability leads us into one of the most complex and, frankly, unsettling aspects of the entire BIP-110 event.
The regulatory and AI implications.
We are looking at the intersection of technical capability, legal compliance, and the erosion of digital truth. Let's examine the regulatory environment and the unprecedented role of artificial intelligence in this conflict. Because up until this point, BIP-110 was an internal family dispute.
It was cypherpunks, developers, and miners arguing over the best way to scale their own system.
But the regulatory state is always watching. How does a regulator view a successful soft fork designed to filter data?
Regulators operate heavily on precedents. The argument against BIP-110 from the protocol neutrality camp wasn't merely about defending the right to publish digital art. It was a desperate attempt to prevent a technical capability from being established on the base layer.
Establishing the precedent that filtering is possible.
If the Bitcoin network successfully coordinates to reject specific transaction structures, it shatters the primary legal defense of the ecosystem, which is the defense of absolute technical neutrality.
The defense being, we can't stop money laundering or illicit transactions because the protocol is just a blind math equation. It processes whatever it's given.
The underlying mechanism there is plausible deniability. But if the network proves it can filter spam, a regulatory body like OFAC, the Office of Foreign Assets Control, will immediately leverage that precedent.
They will say, you proved you can do it.
They will argue, you demonstrated the capacity to coordinate a soft fork to filter arbitrary data last year. Therefore, you possess the capacity to coordinate a soft fork to filter transactions originating from these specific sanctioned wallet addresses.
The technical barrier is gone, so your refusal to comply is now a choice.
Exactly. It sets the stage for state-mandated protocol upgrades.
And the legal friction doesn't stop at censorship. The sources detail the immense tax implications of a chain split. If the network forks and creates a parallel, economically viable asset, tax authorities have to classify it.
Is the new coin a dividend? Is it a newly issued security?
The administrative burden on users to report this is staggering. But while humans are arguing over law and code, the sources highlight an entirely new actor that fundamentally distorted reality during this crisis, AI agents.
The role of artificial intelligence during the BIP-110 standoff was a bizarre, dual-edged sword, serving as both an essential engineering tool and a weapon of mass deception.
Let's talk about the productive side first.
On the productive side, AI was critical for technical analysis. The consensus rules governing Tapper execution and witness data constraints are incredibly dense. Developers utilized advanced AI systems to audit the BIP-110 codebase,
Running massive simulations to identify edge cases, map out the blast radius of the fork, and check compatibility across thousands of different wallet architectures.
AI acting as the ultimate untiring code inspector. That makes perfect sense for a system this complex.
But the dark side of this technology emerged when it was unleashed on the governance process itself. How did AI impact the information war?
To understand the impact, You have to look at how decentralized networks make decisions. Without a CEO or a voting board, networks rely on rough social consensus. Miners and developers gauge the sentiment of the community by monitoring developer mailing lists, GitHub pull requests, Twitter debates, and forum discussions.
But the proliferation of autonomous large language models completely broke that metric of social consensus.
Because you can't tell who is real anymore.
If I'm a miner trying to decide if I should risk my business supporting BIP-110, I look at social media, and it might look like 85% of the community is absolutely demanding activation.
The arguments are articulate, they cite deep technical precedents, they are passionate.
But in reality, it could be a single bad actor running a highly sophisticated prompt loop, orchestrating a massive Sybil attack of AI bots to hallucinate public support. This feels like a sci-fi thriller.
It really does.
We have an open-source money system being fought over by human purists and developers, while AI bots literally scream at each other in the background to sway the vote.
The epistemological crisis this creates is profound. The digital town square becomes entirely untrustworthy.
You cannot rely on qualitative arguments when a machine can generate 10,000 distinct, highly persuasive manifestos a minute.
This breakdown of communication forced the ecosystem to abandon social sentiment entirely. It forced everyone to fall back on the only metric that a language model cannot fake, which is cryptographic proof of work and demonstrable economic weight.
Which brings us to the climax of this story. After months of intense philosophical debates, regulatory panic, geopolitical theorizing, and a digital landscape flooded with AI-generated noise, the countdown clock finally ran out.
The moment of truth.
It was time to see what the network would actually do. Let's look at the activation attempt and the immediate aftermath. The sources pinpoint the activation target around block height 961,632.
This was the moment the theoretical rubber met the road. The node operators who had committed to the user-activated soft fork planted their flag.
They updated their software.
And when the chain reached the designated block height, their nodes began aggressively enforcing the new, restrictive BIP-110 rules.
What was the actual measurable support from the entities physically producing the blocks? How did the miners respond when the deadline hit?
It was a brutal collision with economic reality. To trigger a standard, non-contentious activation, upgrades typically require an overwhelming majority of miners to signal support by embedding specific version bits into the block headers they produce.
And what was the threshold here?
The proposed threshold for BIP-110 was designed to be relatively low to encourage adoption, set at 55%.
And what did the version bits actually show?
The mandatory signaling period revealed that miner support was a dismal 2.5 to 2.6%.
Wow, they didn't even break 3%. That is a total rejection by the industrial mining complex.
It was a comprehensive failure to achieve hash power consensus. The overwhelming majority of the mining industry looked at the orphan risk, looked at the fee revenue generated by arbitrary data, and simply ignored the BIP-110 proposal.
They just kept going.
They continued mining standard blocks following the legacy unrestricted rules.
But the UASF nodes, staying true to their cypherpunk ethos, they didn't back down, did they? They enforced the rules anyway.
They did. When the legacy miners produced blocks containing data inscriptions that violated the BIP-110 rules, the UASF nodes immediately rejected them as invalid.
And so a split happened.
For a brief, highly contentious window of time, a minority chain split off from the dominant network. A parallel universe was born, consisting solely of nodes enforcing the restrictive rules.
But how long did that parallel universe actually survive?
Its relevance collapsed almost instantly, because over 97% of the global hash power remained dedicated to the legacy rules. The dominant main network continued producing blocks at a normal pace, completely unfazed.
The minority chain just couldn't keep up.
Starved of hash power, it ground to a halt. Blocks were found incredibly slowly. It had virtually no economic throughput, no major exchange support, and no structural legitimacy.
The main network just kept chugging along, processing financial settlements and digital frog images side by side, entirely ignoring the rebellion. But I want to explore a very specific technical detail regarding the aftermath, because there was a massive amount of panic circulating about existing funds being locked.
The false taproot panic.
Yeah, I recall reading headlines claiming that BIP-110 was going to freeze people's Bitcoin if they had used Taproot in the past.
That narrative was perhaps the most damaging piece of misinformation to spread during the crisis.
Yeah.
The actual code of BIP-110 was heavily engineered to avoid that exact scenario.
So they accounted for it.
The technical specification included a strict grandfathering clause. The restrictions only applied to transactions verified after the activation block height.
Meaning any unspent transaction outputs, UTXOs, that were created prior to activation were entirely exempt from the new rules.
The idea that historical funds were rendered unspendable was factually false, but the panic it caused really highlighted how few people actually read the underlying code.
So the panic subsides, the minority chain dies on the vine, and the main network remains unchanged. On the surface, it seems incredibly anticlimactic.
But the sources argue that viewing this as simply a failed upgrade is a massive miscalculation.
The true significance of this event isn't that BIP-110 failed, it is what the failure proved about the balance of power.
The failure is incredibly illuminating. Many observers looked at the defeat of the UASF nodes and concluded, well, this proves that miners are the ultimate dictators of Bitcoin. The nodes tried to force a change, and the miners crushed them.
But if the UASF nodes tried to enforce it and failed because they only had 2.5% miner support, does this prove that miners do ultimately run Bitcoin?
No, that is a fundamental misunderstanding of the mechanics.
Because it wasn't a battle of nodes versus miners, it was a battle of economic weight.
Exactly. The UASF nodes pushing for BIP-110 failed, not because nodes inherently lack power, but because this specific coalition of nodes lacked economic gravity.
They didn't have the big players on their side.
They did not have the major retail exchanges, the massive institutional custodians, the wallet providers, or the broad majority of individual users running their software.
The miners didn't unilaterally crush the rebellion. The miners simply observed where the dominant economic consensus lay, and they followed the money.
That is a crucial distinction. It proves that you cannot force an ideological change on a decentralized network simply by spinning up 1,000 nodes on cheap cloud servers.
If those nodes aren't routing significant economic volume, if they aren't the gateways for real-world liquidity, the network will just route around them.
The system relies on a delicate, chaotic balance of power. Developers propose the code, users and economic hubs validate the rules by running nodes, and miners physically assemble the history based on where the profit incentives align.
BIP-110 functioned as a live-fire stress test of that exact balance. It proved that a decentralized protocol can experience a massive internal civil war, absorb extreme philosophical friction, navigate institutional panic, and deflect AI-driven social manipulation, all without the core network suffering a single second of downtime.
The economic incentives worked exactly as Satoshi Nakamoto designed them to work, preserving the consensus of the overwhelming majority.
It is a profound reminder for you, the listener, regardless of your level of technical expertise. Whether you are holding a fraction of a Bitcoin on a hardware wallet in your desk drawer, managing a retail business that accepts Lightning payments, or just watching the evolution of the tech space from the sidelines, the governance of these decentralized systems directly impacts the future of your digital ownership.
True self-custody requires taking the responsibility to actively understand the rules your infrastructure follows.
Because, as this event proved, those rules are not written in ancient stone. They're constantly being negotiated, tested, and fought over in the digital trenches.
And as we consider how those negotiations will evolve in the coming decades, I want to leave the listener with a final, rather unsettling concept to mull over.
What's up?
Throughout this entire deep dive, we have operated on a fundamental, foundational assumption. We assume that the friction in network governance stems from human disagreement.
Right, human cypherpunks arguing over monetary philosophy and human executives analyzing risk models.
But we touched briefly on how AI agents were utilized to hallucinate social consensus. Fast forward the timeline a few years. As AI systems cross the threshold from passive language models into fully autonomous economic agents, the paradigm shifts entirely. These agents will possess the ability to autonomously generate wealth, write their own complex smart contracts, and eagerly pay exorbitant transaction fees for block space at volumes and speeds that human traders cannot possibly match.
Wow.
What happens when the next contentious soft fork isn't a battle of humans versus humans? What happens to the philosophy of sound money when a network purist, desperately trying to keep the blockchain clean for human peer-to-peer payments, finds themselves up against the sheer, unstoppable purchasing power of autonomous machines that view the global blockchain as their native operating system?
If the machines can effortlessly pay the highest toll, who are we to tell them they can't use the highway? That is an absolutely brilliant and terrifying question to end on. Thank you for joining us on this deep dive into the BIP-110 crisis. Keep questioning the rules, keep digging into the mechanisms that govern our digital reality, and we will see you next time.